Growth stocks are in a deep bear market, and the poster child ETF for this, ARKK, has gone from a peak in Feb 2021, about a year ago, now down around 50%. So if your portfolio has similar stocks to what ARK has, the Rokus, the Teladocs, the Palantirs, you have definitely suffered some of this pain as well in your personal portfolios, and I've watched these stocks consistently bleed week after week as their multiples, particularly the price of sales, drop lower and lower. And trust me, it's not fun to see this. It's a lot more fun when stocks go up week after week and you see green in your portfolio. But guess what? Bear markets are just part of the cycle. It's just part of what makes us good investors long term. And if you're able to withstand this pain and come out of it, you will most likely learn a ton of valuable lessons. So when we do have the next bull run, eventually when that does come, you'll be able to pick better businesses to kind of reduce the pain you see in future bear markets. Always take these times of uncertainty, of fear, of red as learning lessons to improve yourself for the future. You have to understand, bear markets are normal. It's part of the cycle. And what happens during these times is that the crappy companies get separated from the great companies, and those crappy businesses end up going lower and lower and lower, heading to that $0 mark, whereas the good businesses, they give us a discount, we can buy in, and then eventually they will turn around and recover and make new highs. These are times that you can truly build wealth in your accounts, and if you have high conviction and you've done research and you really understand the businesses that you're investing in, there's a lot of money to be made. But just remember, guys, the key is that not every single growth stock that's down today is going to bounce back and recover and make new all-time highs. There's a lot of them that have just been pumped on hype, on high liquidity, on just euphoria in the markets, and they may not see their highs for many, many years to come, or some cases ever again. So it's more important now than ever before to really pick good businesses that actually show us that they're on the path to becoming even better, which eventually means the stock price will follow as well. Now, back at the beginning of October, I shared this post with my VIP members in our Discord, and I think this is a solid framework to follow in this environment if you're looking for growth stocks. Look for companies generally with strong revenue growth. I try to look for 30% plus, but even, the high teens, 20% plus is still reasonable. You want to see good gross margins. Of course, the higher, the better, ideally above 50%, but depending on the sector, it may be a bit lower than that. You want to see strong growing free cash flows, and you ideally want this to be positive or about to be positive in the next year or so. And then finally, you want to see low debt on the balance sheet. You want to see a high amount of assets versus liabilities, because this means these companies are well capitalized and they can keep reinvesting to keep growing. And following these 4 simple steps helps us rule out some of the worst quality business from the higher quality business, and it helps us make more informed investment decisions. And during these times, it actually helps us keep a lot more sanity in our portfolios. Personally, I use this to kind of separate the fakes out there that look like great businesses, have great stories, but under the hood, the fundamentals don't really make sense. I skip over those. And then I also look at my personal portfolio, stocks that I hold, run them through this and see, are there any that need to be cut? And that was actually a big reason as to why I cut Peloton recently. There is a ton of opportunity out there right now in the markets. And if you comb through, take the time to understand what companies are good, what companies are not so good, you have the potential to make multi-bagger returns over time, because these are the times, again, that money is made. But just remember, you have to have a long-term horizon. You can't just buy into these stocks and hope that next week they bounce back and you make a ton of money. I'm sure with this volatility, there is some short-term money to be made. However, it's typically very difficult in these market conditions to make money short-term. So I like to just pick businesses that I think will execute over the next 3, 5, 10 years, just compound over time, and just have them sit in my portfolio and just bring me in money month after month, year after year, and all I do is just watch it grow. Okay, so now let's kind of talk about, why are these growth stocks falling? Why do they keep bleeding week after week? And is the bottom near? Well, so there's a few things going on that's affecting these growth stocks directly. And, while inflation keeps coming up as a major factor, I think it's more so the Fed's reaction to inflation and what they're doing right now that's hurting these growth stocks and not the inflation itself directly. The Fed has started tightening their balance sheet. The Fed is not printing as much free money as they did before. They're going to start possibly raising interest rates this year. And all of these things contribute to a tougher environment for businesses that don't make money today. Over the last, year, 2 years or so, any business that's kind of had a little bit of a tough time, the Fed just comes in, they help them out. There's a ton of money out there, a ton of liquidity, and there's no real fear of companies going bankrupt. Money is just all around freely available. Now, money starts to get a little tougher to get hold of, and companies that don't make money today and their valuations are projecting for them to make money in 5 or 10 years, investors start to question whether they want to hold those companies because there's a risk now that those companies could face tougher times and some will probably go bankrupt. All of a sudden, we've gone from a market that's kind of like, you know what? It doesn't matter what the price of sales is. These companies are growing fast. These companies have great stories, great brands, all this stuff, to valuations matter, free cash flow matters, how much cash they have on their balance sheet matters, and that's typically the environment that we're usually in, and the last 2 years has kind of just been a little bit of an abnormality, and hopefully you didn't fall trap into this, but if you did, it's not too late to pivot your strategy and kind of focus on valuations once again. The bottom line really for why these growth stocks are falling is that the free money period has ended. The Fed has gotten tighter now with their policy, and this typically means that higher valuation companies suffer. So now, in terms of is the bottom near, I think we can kind of separate stocks, growth stocks, into kind of two separate camps, especially when we look at their forward price to sales ratios. So here's an example. You have C Limited, which is a very popular stock. It peaked in February at a price sales of around a 20. Historically, before COVID, it's been at around a 5. And this multiple now is contracted from a 20 to an 8. It's still above the 5. But it's a lot more attractive today than it was before. Cloudflare, ticker symbol NET, is another one here that's peaked at around the 80 price to sales, absolutely bonkers. And this one has come crashing down now. It's kind of cut its valuation in half, but there's still a long ways to go before this is more reasonably valued. So you have a basket here of stocks like C Limited, of stocks like Cloudflare, bunch of other stocks out there that still have their valuations well above where it was pre-COVID. Now, some of these businesses are much better than they were pre-COVID, yes, but the multiples still matter, and you're not going to pay 10 times as much as you did pre-COVID or double the amount pre-COVID just because the business is growing a little faster or they're generating more cash. So I think that these type of stocks still have room to go before they bottom. But on the other hand, you have another basket of growth stocks which actually look quite interesting and quite reasonably priced today. DocuSign here has dropped from a peak of 35x to around a 10x now, which is where it was pretty much prior to COVID. Roku, another popular name, contracted from around 25x to now a 6x or so, back to nearly the lows of March 2020. So that one's interesting. And then here, one Mercado Libre, one that I personally like, going from around a 20x at its peak to now around a 6x, again, lower than its March 2020 lows. So these three companies have benefited greatly as well from COVID. They're all better businesses today than they were in March 2020. They have better balance sheets typically. They're generating more free cash flow. Their growth has grown steadily. They're just more dominant companies, but they're trading at valuations cheaper than it was prior to COVID. So these are opportunities, in my opinion, that are just so attractive that they make sense to buy right now, even if they haven't bottomed quite yet. Now, this basket I think is quite close to bottoming. Again, we don't know when the actual bottom is going to be, but I think what we may start to see is kind of the highly valued growth names versus the more cheaper and reasonably valued growth names separate themselves, where these stocks kind of start to recover, start going higher, and the richly valued ones just keep bleeding week after week for the foreseeable future. Investors will eventually see value in names like Roku, Mercado Libre, and even DocuSign here, because when you're looking at just metrics and fundamentals of the business, the numbers just make sense right now. And that's kind of the point I'm trying to get across to you guys. Not all growth stocks are created equal. There's still richly valued growth stocks. There's still undervalued growth stocks. Right now, they're all kind of clumped in a bucket and they all just keep dumping week after week. But this is where our kind of individual analysis, stock picking, research comes into play. And that's what I spend a lot of my time doing when I try to figure out what stock I want to add to my portfolio next, or what stock I want to add to that's already in my portfolio. So we have earnings season actually coming up very soon for a lot of these stocks, and that could signal the bottom for these stocks, especially the ones that are kind of fairly valued or undervalued here, because they could post good numbers, they could show that inflation is not really too much of a concern, the Fed moving is not really much of a concern. They may even address that on their calls, and that could alleviate some fear that the market's feeling for the sector as a whole. But again, I'm not necessarily waiting for a bottom before I start buying in, because I feel that that's kind of a fool's game. If you see value in companies that you absolutely love, I think dollar cost averaging makes the most sense, and that's kind of been my strategy for many years. Sure, I don't cash the absolute bottom, but I get a good enough price where I'm happy with. I'm able to average down if the stock goes even lower, and in the end, it ends up turning out a pretty good way to invest, in my opinion. I've had returns in Nvidia of 600%, Tesla 1000+%, Align couple 100%, Apple couple 100%, and I've used a strategy for all these stocks, all great businesses that have at some period of time fallen off, sold off, and I didn't try to time the bottom. I just felt at a certain price it made sense. I averaged in, and now I'm getting rewarded for that. And I think the stocks I'm buying today, 5 years from now, I'm going to look back and I'm going to say, I'm glad I bought those, because those were no-brainers at the time. So guys, just do your research, kind of follow the 4 steps that I outlined earlier in this video. And if you're interested to see what stocks I'm personally buying right now and what my portfolio looks like right now, consider joining our VIP group. Link description down below. I'll pin it as a comment as well. But either way, if you have any questions, you have any concerns, you want to share some of your ideas, leave them in the comments down below. I read every single one of them, and I'm sure the community appreciates it as well. Thank you so much for watching, guys. Don't forget to invest positively, and I'll see you in the next one. Peace.